The dollar is falling and there is a chance of a second wave of inflation. I'm sure we've all seen the CPA report from June, which says that inflation has dropped to 3% and prices have only gone up by 3%. We only need 100 more points to reach the goal. Remember that Powell's goal is to get inflation down to 2%, and it looks like he's almost there. Biodynamics seems to be working right now, and the president is on his way to selling the world on a strong economy. But we shouldn't accept this as the way things are. We need to see through the smoke and realize that this is just the calm before the storm. The war is still going on. The US dollar is falling because everyone expects the Fed to stop raising rates or just raise them once more. I have bad news, especially if you are an American. As the dollar falls, and because of how the BLS figures the CPI, we will see a second wave of inflation. It will be like an earthquake with aftershocks that we are not ready for. If inflation goes up, it could cause a big crash that surprises everyone. Now, the Federal Reserve has said that the job isn't done yet, and that more rate hikes are still on the way. But the Fed has given us a goal that we can work toward. The Fed governor told Bloomberg that the Fed will need to raise interest rates twice more to keep inflation in check. In 2023, we can expect at least 50 basis points more. But they also say that a September pause could happen if 2 more good CPI numbers come out. This shows that not even the Fed fully believes the June number on inflation. They need to see more proof. I want to make something clear about the CPI. The BLS has changed the way it calculates inflation to use a 12-month measure. This means that the 3% inflation number for June is based on the 9.1% inflation number from June 2022, which seems like a terrible number. So it makes sense that the CPI for last month would be 3%. It's like comparing a fire explosion to a volcanic event, which is still bad, but not as bad as 9.1%. This is why it's crazy that the stock market keeps going up. You can only ignore truth for so long, because when more rate hikes happen, it will throw the financial system for a loop. But the CPI is not what Powell is really looking at. The recommended measure is core inflation, which takes out the more volatile parts of inflation, like food and energy prices. In June, food prices went up by 5.7%, while energy prices went down by 16.7%. When you take these out, you get the inflation of goods and services that don't change quickly. This is the real number that the Federal Reserve is working to get down to 2%. The core rate of sticky inflation is still 4.83%, which is just under 5%. This isn't good news, because inflation is still above 2% and is almost at the rate the Fed wants it to be. Prices have stayed high and aren't going down as quickly as Powell would like. The US economy still looks strong and sturdy, but that's not true. The simple numbers can be confusing, and it's a worry that the US dollar is so strong. The fact that the dollar is the world's main currency is both a gift and a curse. As it gets weaker, it makes imports more expensive for the US economy, which buys the most goods from other countries. This adds to the push for inflation, which we haven't fully seen yet, but will soon. Most likely, the CPI numbers for July and September will be higher than 3% and will stay around that level until the end of the year. The Federal Reserve has nowhere to go. They can't just make more money to save the economy, and they can't cut interest rates yet because the government spends too much. The US economy is being hurt by the huge deficit spending, especially on defense, which is also adding fuel to the fires of inflation. Spending too much on defense is not flexible, and borrowing money at high interest rates to pay for it puts a lot of stress on interest payments. This will take money from other parts of the business, which will make things even worse. The reversal of the yield curve is a strong sign that a recession is coming, and the New York Fed's model shows that there is a 67% chance of a recession in the US by June 2024. Interest rates of 4% to 6% for the next 18 months are too much for the business to handle. The market knows this, which is why people are rushing to buy 10-year government bonds to lock in yields. In the end, we are sitting on a ticking time bomb that is about to go off. The Federal Reserve is in a tough spot, and as September comes, we are facing a second wave of inflation. It's important to be ready for what's to come, because the market might not be as strong as it seems. In these uncertain times, money market funds and gold could be better investments. Tell me what you think in the comments below. Do you think the Fed will raise rates again in July and September? Or do you think inflation is under control? Stay safe, and don't forget to hit the like button and subscribe as we go through these hard times.